Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill, your host. Later on, we'll speak with Roy Friedman of Dillon Gage. Dillon Gage trades, stores, and refines precious metals and diamonds. Our discussion will focus on gold, silver, platinum, and palladium. But first, a few words about gold and some fundamental facts about gold that are found in an article entitled, "Let's Get Real About Gold. It's a Pet Rock," by Jason Zweig of the Wall Street Journal from last weekend, July 18, 19, 2015. Zweig notes that gold rose by 18.7% per year from 2002 through 2011. That was the era of the gold bug. Gold peaked at about $1,900 an ounce in August of 2011. Since then, has plunged by 39% and recently reached a 5-year low in trading at less than $1,150 an ounce. Total assets at precious metal funds have plunged by 20% in the last 12 months. For a longer perspective, since 1975, when private ownership of gold became legal again in the United States, the average annual return of gold has been less than 1%, 0.8% after inflation. This compares with the after inflation annual returns of 5% for bonds over that period, the last 40 years, and 8.3% for stocks. Well, gold seems to be at a low. Is this a time to buy low and sell high? After all, that's a fundamental aspect of Mr. Buffett's investment strategy. Well, don't take my advice. I don't have any to give you. But I will point you to a white paper by Carteret Grant, dated March 29th, 2015, about behavioral finance. It's entitled Behavioral Finance, 6 Principles That Fuel Your Clients' Fears. And it can be found at www.investmentnews.com in the White Pages category. Behavioral finance is posed contra classical economic and investing theory. In classical economic and investing theory, people are presumed to act rationally to maximize their interests. Behavioral economics looks at the subrational, irrational, non-rational factors of decision-making in investing and other things. So 6 behavioral financial insights, and I will go through them very briefly, are presented and discussed in this useful article. First, loss aversion. It hurts more to lose than it feels good to gain. The same amount of loss creates greater pain than the amount of pleasure one gets when one wins by the same degree. Then there's anchoring, which is the human tendency to focus on one piece of information, usually the first piece of information about something before making a decision. Familiarity bias. Well, if something's happening now that you can analogize to something that happened in the past, well, you're going to come to a decision quickly based upon that experience. Mental accounting is how we compartmentalize our thinking about money, among other things. But to some degree, of course, things like mental accounting are unavoidable. But the fact that we do it and how we do it bears upon the nature of our decision-making. The gambler's fallacy might have particular application to gold. The gambler's fallacy is that past patterns influence future odds. If you flip a coin 10 times and it comes up 8 times as heads, well, you're bound to get more tails on the coin flip over the next 10 times. Well, that's not true. If something is down, it need not go up. It may stay down. But the tendency is to think that it will go up. And finally, one to which we can all relate is herd behavior. To pile metaphor upon metaphor, herd behavior causes and inflates bubbles. When one participates in a bubble, one follows the hot fund, one follows the hot stock, both up and down. So you're selling while prices are plunging. You're buying while prices are rising. That's a good way not to make very much money at all. The point of behavioral finance, I think, is to bring us to awareness of how these behavioral principles guide our thinking. How our thinking is really not our thinking, unless you acknowledge and account for such mental habits. Let's give some news. Hedge funds are doing better than the S&P 500 index over this year. Famously, hedge funds have not met the performance of the S&P 500 index over the last year. It fell well short of it. Looking at an article entitled HFR Hedge Funds Returned 2.4% in the first half of the year, topping U.S. markets. Published July 8, 2015 on Pensions and Investments, www.pionline.com. So very quickly, this is all data compiled by the HFRI company, and it's called the HFRI Fund Weighted Composite Index. According to that, hedge funds have returned 2.4% in the 6 months ended June 30th. The return of the S&P 500 index over the same period of time, about half, 1.2%. Of course, you have to pay a fee for the hedge funds, but let's leave that to the side. The things that beat hedge funds and the S&P 500 were the MSCI World ex-US Index, which had a return of 4.8%, and the MSCI Emerging Markets Index of 3.1%. And I should note that according to this research, the HFRI Fund Weighted Composite Index returned 2.1% in the first 3 months, but only 0.2%. That's 20% of 1% in the 3-month period ended June 30th. So it's not as though hedge funds are accelerating in their return. They're not. But they're beating the S&P 500. Interesting. Do I know why? I don't know why. Kenneth J. Hines is the president of HFR, which did the research. And this is what he has to say. This outperformance highlighted, quote, an important performance inflection point. As recent macroeconomic uncertainty develops in coming months, hedge fund investors are likely to continue to benefit from sophisticated, non-directional, and low beta exposures to many powerful, complex, and diverse trends, end quote. If you can tell me what that means, please type out a translation and send it to me at CCAHILL, that's CCahill at financialpoise.com, because I don't know what that means. Economics is called the dismal science. I don't agree. I don't think it's dismal at all. But financial reporting and financial punditry can be dismal and even incomprehensible. But let's not end on that note. Let's end with a triumph of innovation. Jimmy Buffett is known to have said or sang about getting a tattoo. In summary, he said, how it got there, I haven't a clue. And maybe some of you out there have felt the self-loathing at having a tattoo hanging around your neck, metaphorically speaking, for the rest of your days that you regret. Well, I'm here to say that smart weaponry has been developed for the face and all the other body parts you tattooed by mistake. The article title is entitled, Tattoo Regret, No Laser and No Pain, and can be found in the Life Hacks section of www.financialpoise.com. The article describes a cream that's been developed that kills only the tattooed cells, leaving the healthy cells around the tattooed cells undamaged. That's by contrast to laser treatments, which kill a lot of healthy cells. So you might say, that the cream does not create any collateral damage. Or, if you want to stretch a pun, the cream does not create any collagenal damage. Oh, well, you're forgetting that bad pun. International law has the doctrine of proportionality for the use of weaponry among civilians, and if the use is disproportionate, it's a war crime. Well, laser treatment kills a lot of innocent cells. With the new cream, all you lose is that permanent reminder of Margaritaville, and all you lose is your regret therewith. So you get freedom from the consequences of your lamest actions. That, my friend, is progress. Let's get to the interview. Well, we're here with Roy Friedman, who is Executive Vice President of Business Development for Dillon Gage Metals, one of the largest precious metals dealers in the United States. I'd like to spend a few minutes on his bio because I think it's interesting. Roy earned degrees in economics and political science in 1980 from the State University of New York at Binghamton. Then he went into precious metals. As a former political scientist, I can tell you that Roy seems to have thus turned lead into gold. He started with Mocatta Metals. He clerked on the commodity exchange trading floor for 4 years. Then he traded with AIMkts Precious Metals. And this takes us to the end of the 80s, whereupon he joined with Crédit Lyonnais, that's a French investment bank, as a trader. In 1990, he was recruited by a founding member of the London Metals Exchange to create that company's metals division based in New York, which has grown to a global foreign exchange division of the London Metals Exchange. In 1998, Mr. Friedman started his own company, RF Capital Management, to provide asset management for high net worth clients. In this century, Mr. Friedman returned to AIMkts Precious Metals as a vice president, and in 2012 joined Dillon Gage. All I can say is you can see what you can do with political science and economics, even from a non-Ivy League school, if you have the drive, acuity, and assiduousness of Roy Friedman. Good to have you with us.
Thank you. Thank you for having me.
Okay, so we're going to talk about precious metals, but first a word about your firm. Dillon Gage describes itself as a, quote, wholesale trading firm, end quote. So how's that different from other firms that trade in precious metals?
Well, there are a handful of firms, both in the United States and internationally, that I would refer to as a wholesale trading firm. And I often describe or try to visualize for someone I'm speaking with, where we are in the process of distributing precious metals. And if you think of the market as a pyramid, I say Dillon Gage is a primary wholesaler because we are at the top of the pyramid. Mm-hmm. We are the company that buys directly from the sovereign mints. With regards to the United States Mint, there are only 13 companies that can buy gold, silver, and platinum directly from the U.S. Mint, and Dillon Gage is one of them. And we share a similar standing with all of the major sovereign mints, including the Royal Canadian Mint. And we buy directly from the British Royal Mint, et cetera, et cetera. In addition, we have the same standing and the same relationship with many of the largest refineries around the world, such as the Rand Refinery in South Africa, the Royal Canadian Mint again in Canada, Johnson Matthey here in the United States. And we buy those products directly from the fabricator. And we in turn distribute those products through a network of coin dealers and investment advisors, until the person who's actually making the investment, winds up with the metal, in their choice location, whether it be their home or a storage and depository facility. So Dillon Gage buys at the top and distributes until the end user or the actual purchaser of the metal receives the physical product.
Well, if there are not so many wholesale trading firms, by the time a retail purchaser makes contact with the metal and wants to buy actual precious metals, Will that person be quoted diverse prices by different dealers, do you think?
Well, price discovery, needs to be investigated by the person who's actually making the investment. In the case of Dillon Gage and some of the other wholesalers, when buying directly from the U.S. Mint or the Royal Canadian Mint or the Rand Refinery, the wholesalers all pay the same premium to the fabricator of the metal or the mint that is producing the metal. And that metal is then distributed sometimes, to an intermediary, perhaps even two intermediaries before the purchaser receives, his or her metal that they ordered. We live in a capitalistic society, and everybody in our industry is working to make a small profit on every transaction. Dillon Gage is no different than, as are the wholesalers and retailers that we sell to. So everybody adds, a small markup. I would feel comfortable saying that, as long as your listeners are buying from a reputable source, they're getting a fair price. But that price includes a profit margin for, anybody who was involved in the transaction.
Naturally. So what are the various means by which investors can invest in your four principal precious metals? And by the way, why is it only those four: gold, silver, palladium, and platinum?
Right. Well, Dillon Gage has carved out a niche market for itself in what is commonly referred to as the precious metals. There are other groups of metals, namely base metals, which tend to be more an industrial commodity. Precious metals, while they certainly all have applications in industry, tend to be viewed more as an investment opportunity, and as such, Dillon Gage has focused on those four precious metals, which we believe, have the greatest appeal to the investing public.
Well, then Dillon Gage has an electronic trading platform. What does that allow investors to do, and what kinds of minimum investment amounts are required?
Well, Dillon Gage's electronic trading platform is just complete state-of-the-art technology. We are the only wholesaler in the market right now that has this type of technology that we can offer to all of our customers, regardless of whether they are the biggest customer we have or the smallest customer we have. The technology provides everybody with the same service, and no different than logging on to your checking account and balancing your checkbook, or doing something such as buying or selling a stock, through a stock market clearing members internet trading system. Our system provides the same type of technology and the same type of ease and the same type of convenience. It allows a purchaser, and for that matter, somebody who's looking to sell as well, it allows somebody who's looking to trade physical precious metals to do so at the time that is most convenient for them. If they have a 9-to-5 job and it's not convenient for them to shop the best price on Gold Eagles or Silver Maple Leafs, whatever they're looking to purchase, they can log on to our PhysTrade platform 24 hours a day and purchase whatever they would like. So for convenience sake, it offers an opportunity that nobody else in the market is able to offer.
And this is for the trading of actual physical piles of metal.
That is correct. Dillon Gage is in the business of buying and selling physical precious metals, and that is the service that we offer, to our clients. Physical precious metals. So
after hours, if it's 11 p.m. in Chicago, is that Chicagoan trading with somebody in Australia or somebody elsewhere in the world? Are there?
Right.
Is it a worldwide scope?
Yes. The gold market, the silver market, platinum and palladium inclusive, are actively traded from Sunday afternoon U.S. time when the market opens in the Asia Pacific community until the close of business United States time again on our Friday afternoon. So for 5.5 days a week, Sunday afternoon through Friday late afternoon, and running 24 hours a day during that period, price discovery is available to anybody who seeks it. And because Dillon Gage is an active participant in the global market, we always know exactly what the price of gold and silver, platinum, and palladium are 24/7, and that enables us to offer phys trade pricing electronically, to any customer, regardless of where they may geographically be located, to log on to our platform and buy and sell at their convenience.
Not to get too deep into it, but there are then willing buyers for willing sellers at, in the middle of the night, Chicago time. They're out there.
They are, but Dillon Gage is not, is as a wholesaler, as a primary market maker, in the precious metals, physical precious metals trading around the globe, we are not looking to match up a buyer and seller. What we do is we offer a price that we're willing to sell something, and we offer a price where somebody is maybe looking to sell to us, and we hedge those trades, and we hedge each trade independently. That may be something you would like to discuss, throughout the interview or later in the interview, but the concept that you may be trying to relay to your listeners, whereby Dillon Gage is matching up a buyer and a seller 24/7, is not the correct concept.
Okay.
We are arbitragers in the sense that when we sell something, we buy something, and when we buy something, we sell something. So we stay neutral in the market, and we hedge every transaction, but we don't necessarily buy 10 gold maple leafs from a third party if somebody is buying 10 gold maple leafs from us, for argument's sake.
Okay, but you facilitate the trading through your intermediation.
Correct. We facilitate the trade and offer liquidity to all of our clients using our expertise in hedging and our ability to hedge whenever a client wants to trade.
All right, so it's electronic trading platform plus market making, the two together.
That is correct.
This is physical ownership. Wherever it's held, it's still physical ownership by the purchaser. What advantages are there in buying and holding precious metals themselves physically as compared with purchasing shares in an exchange-traded precious metal fund or purchasing precious metal futures?
Yes. Well, everybody, has an opportunity to invest in the vehicle that makes them most comfortable. And physical precious metals, for one reason or another, may not be, any particular individual's choice. But the clients that come to us who want physical precious metals want them for the security of actually having the liquid investment under their control. In times of uncertainty, if you own shares in a 400-ounce gold bar in London, or you own a futures contract from the New York Futures Exchange or the Chicago Futures Exchange, you have a liquid investment, but in difficult times, in times of extreme uncertainty, that investment, you can't put your hands on that investment. You can't turn that investment into something else. You couldn't sell your shares of a 400-ounce gold bar on a Saturday and have currency in hand immediately.
Right.
By owning physical precious metals, you have something to barter with, in extreme uncertainty, and you also know that your investment is fully paid for and fully secured because it's under your custodial control. And that's not something the other investment vehicles can offer.
And that raises to me the question of whether sovereign entities, maybe smaller nation states, sometimes buy and sell on your platform.
To be totally honest with you, sovereign governments and the central banks, the largest central banks in the world, when they buy gold, and if you read the monthly reports issued by the World Gold Council and several other well-known financial sites, you will see every month central banks disclose the amount of gold that they have purchased, or for that matter, if they have sold any gold. And the central banks, regardless of whether they are very big or very small, from emerging nations, they typically purchase 400-ounce gold bars, and those 400-ounce gold bars are kept in a secure location. That's how central banks invest in gold. And under the heading of full disclosure, there are no central banks that are at the moment buying and selling gold maple leafs and silver maple leafs, et cetera, like retail investors are buying. They buy in a different fashion, and they do those trades with different financial institutions.
Good. Well, Roy Friedman wrote an article that's on accreditedinvestormarkets.com entitled Precious Metals Investing, 5 Do's and 4 Don'ts. It's dated June 9th, 2015, so very fresh. I'm going to read a paragraph from it. This concerns the pricing of the 4 precious metals that his company deals with. So far in 2015, all 4 precious metals have retained stability in their respective spot price range. Gold is trading at virtually the same price as the beginning of the year, just under $1,200 per ounce. Over the same 6-month time period, silver is up 6% to $16.75 per ounce. Platinum is down 8%, just over $1,100 per ounce. And palladium is down a modest 3%, or $775 per ounce. All right, so here's a simple-minded question. Why don't gold, silver, platinum, and palladium more closely track one another?
It's a good question, and over the course of the many years that I've traded, different factors affect the metals in different ways. Gold and silver tend to move a little bit more in the same direction. Platinum and palladium tend to move in the same direction, but the 4 metals often do not move in the same direction. So the answer to that really begins with where the demand for the metals is greatest, and where the metals demand is coming from with regards to the investment community. Gold and silver at the moment, as they've often been viewed as a hedge against inflation, as a hedge in uncertain times due to geopolitical conflict, have been somewhat volatile. And over the course of the last year, you've seen gold and silver spike higher due to unrest in North Korea, South Korea. More often than not, over the last couple of years, gold and silver have moved higher during chaotic times in the Middle East, especially as the price of crude oil may be going up or may be going down due to conflicts beginning or conflicts ending. Platinum and palladium tend to have greater sensitivity, not necessarily based on their hedge of inflation or their hedge of economic uncertainty, but they're affected greatly by industrial demand, often associated with emerging markets, because platinum and palladium are key components in industry. And as we have seen throughout much of the last year, although the United States does appear to be coming out of its economic doldrums, much of the rest of the world, with China being at the top of the list, have had a severe economic slowdown. And during times of economic slowdown, industrial metals and base metals prices fall simply because demand is not as good as it used to be. And that's what we've seen with platinum and palladium. Demand continues to be somewhat depressed due to the uncertain economic climate in most of the rest of the world, outside of the current United States rebound.
It pays, I think, for people who are interested in these metals to look at the web and learn about what platinum and palladium are used for. It's interesting. I won't go into it in any detail, but the practical and industrial uses are very diverse and, as I say, fascinating. Not really the case as much with gold and silver, and that helps explain or correlates with what you were saying. I note one little fact about palladium. According to Wikipedia, which is a scientific authority, of course, palladium does not react with oxygen at normal temperatures, so it does not tarnish. However, it does tarnish in moist air containing sulfur. So I guess it's a good thing you can't take it with you, because if you could and were in hell, your palladium would tarnish.
Nobody wants to buy anything that's tarnished.
Right. Does gold closely track the price of oil, and does a stronger dollar axiomatically mean weaker prices for precious metals? Gold and silver, at least.
Gold, there's no 100% rule that I can give you and your listeners, with regards to investing in precious metals and what makes gold go up and what makes gold go down. It's just simply not that simple. And the rules that or the supposed rules that I learned many years ago when I entered the market, those rules 20, 30 years later don't hold true. There are new rules, and the investment climate is always changing, and markets to some degree are all interrelated. And what affected gold 25, 30 years ago, which is when gold began to become a very popular investment, was hyperinflation. Gold, a couple of years ago, when it made its historic U.S. dollar high value, did that during a period of incredibly low inflation. So it was the value of the U.S. dollar and and all of the stimulus programs that our central bank was employing that drove gold to its record price. So I can't stress enough that there's no rule of thumb. Historically, gold and crude oil have traveled a similar path, and gold traders look at the price of crude oil as an indication of what the market might do, as do crude oil traders look at gold just to see and get an indication of what crude oil may do. The markets all have some relationship. At the moment, crude oil, although it's bounced from its lows of a few months ago, is very depressed price-wise, historically that is, over the last 10 to 15 years, because the United States is now producing more crude oil than it ever has in the history of United States crude oil production. And as such, there is much greater supply on the market than there has ever been before. And if crude oil, has an impact on inflation, which it does, and inflation remains at historically low levels, it's one of the reasons that gold has sold off, to its current level from where it was just 3 short years ago. When crude oil turns around and moves back up, gold will probably do the same. But that is just speculation. When that time comes, there could be other factors affecting the market that drive the two in opposite price points. That is.
That's where I think I was getting to with this, and you aptly demonstrated, is a man with 35 years of experience in trading precious metals isn't prepared to make the confident predictions that are made every day in diverse directions in the financial pages with respect to the relationships among gold, oil, and the dollar.
Everybody is entitled to an opinion, and that's part of what makes the market so exciting and so unpredictable. My opinion is just my opinion. The fellow around the corner may have the opposite opinion, and that all lends itself to the subject of of not putting all of your eggs in one basket. A wise advisor, a wise investment advisor, or someone who's managing their own investment portfolio, hopefully recognizes that not all of the markets move in the same direction at the same time, and this is why everybody, myself included, recommends having a little bit of this and a little bit of that, and having a diversified portfolio. So at the end of the day, the ebbs and flows of any given market don't have a dramatic adverse effect on your, financial well-being. everybody has a point of reference with where they may want to be overweighted, but, at the end of the day, having a balanced portfolio is the key.
Good. Well, let's finish then, since you've described yourself as having one opinion among many people who have opinions, with your opinion about the outlook for precious metals as interest rates rise in the U.S. I read somewhere today that a Fed authority predicted a rise in November. I'm not sure who predicted it or whether it's going to happen.
Governor Powell said yesterday that 2 rate hikes this year are still a possibility, I believe was the quote.
All right. Well, then the market's going to price that in to some degree, right, and then it'll happen. And what would you hazard to say about the outlook for precious metals under these circumstances?
The market at the moment, nobody can pick the bottom and pick the top. It doesn't happen very often, and I don't think in the current light of the way the market is trading, anybody can tell you exactly, where the low is going to be, and for that matter, what the next all-time high may be. Clearly, precious metals, just like all other, investments, whether it's bonds or the S&P 500 or an individual stock, are all greatly affected by monetary policy, that our Federal Open Market Committee will see fit to impose on all of us, over the coming months and the coming years. Economic data certainly indicates that the worst is in the rearview mirror with regards to the U.S. economy, and as such, Fed officials, FOMC voting members, are clearly biased towards beginning to move rates higher, and they use the term normality, moving us to a more historic median interest rate environment. In an environment of rising interest rates, typically the U.S. dollar rallies, and if the U.S. dollar rallies, the rule, as we discussed earlier, but is not a guaranteed rule, but is that precious metals and most commodities will go down in price as the U.S. dollar gains strength.
But if the U.S. dollar gains strength and if there's greater economic activity, wouldn't more catalytic converters be set?
That's correct. So, that's a perfect example of there is no rule of thumb. So my answer to your question is markets, are, whether it's precious metals or any other capital market, are all forward-looking. And investors are not necessarily investing for tomorrow's price, but where is the price going to be, 6 months from now or 3 years from now? That's the mindset of most precious metals investors. We're not day traders. We're not, speculating, 300 times a day or 200 times, a year. We're taking longer-term view of the market, and that's what physical precious metals traders do. So I think the likelihood is that we can continue to see gold and silver move lower in the short term. How much lower? That's the key. That's the question that everybody wants the answer to. With gold currently hovering around 1175, 1185, which is where it was trading a few hours ago. I don't think the market goes below $1,100 an ounce. If it does, I would be shocked if it goes below 1,050.
Okay, that's pretty specific.
And so is there 10%? In my opinion, does the market have exposure to dropping another 10%? Yes, it does. But if you're looking for the longer term risk reward in the market, and that is what I believe physical precious metals traders do, they have a much longer outlook, and they have a greater tolerance, for not necessarily picking the bottom, but holding on to the investment. I think in the coming years, whether it's inflation or a geopolitical event or potentially, another slowdown in the global economy where central banks are forced to, come out with one stimulus package after another, I think the upside potential for physical precious metals, gold, silver, platinum, and palladium, the upside potential, I believe, is much greater than the downside risk. And that's how I prefer to look at the market. Nobody's good enough to buy the bottom, and subsequently nobody's good enough to sell the top. The key is buying, is getting into the market at a price you feel comfortable getting in, and that's a choice every investor gets to make for themselves.
Well, all right. Thank you, Roy Friedman of Dillon Gage.
I hope we get to do this again in the near future, and if there's anything further, please don't hesitate to contact me.
Well, with anticipated movements in this market, there should be something further.
I certainly hope so. I think we will see a very volatile second half of the year as the FOMC begins to initiate their rate hike objectives, and this should add volatility to the market, and volatility is likely to bring an increase in investor activity. So these are all good things in the short term that I expect.
All right. This has been Accredited Investor Markets Radio. The producer of Accredited Investor Markets Radio is Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short-written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.